until July 5 this year, that is this financial year from 1st of April, the rupee depreciated 4.1% to 79.30 against the US dollar. Today, I mean, it has recovered a little bit in the last 2 days, been up and down. It was 79.25 in one place, 79.90, but it's there in the 79 to 80 horizon. But until July 5, it had depreciated 4.1%. Foreign portfolio investors pulled out 2.32 lakh crore rupees in 6 months, in the last 6 months. India's foreign exchange reserves fell by $50 billion over the last 9 months. So this was these falls, especially the value of the rupee and the outflow of the US dollar, was a wake-up call. And that wake-up call forced the Reserve Bank of India to act earlier this week. And it announced a series of steps to attract foreign dollars, foreign exchange, and boost the rupee. Hello and welcome to Macro Sutra. I am YP Rajesh, managing editor at ThePrint, and I have Radhika Pandey from the NIPFP here with me. We will be talking about the pros and cons of what the RBI has done. Can the RBI's steps announced this week attract more foreign exchange and support and shore up the rupee? What are the pros and cons? And is it really possible? Will these steps work? Hi Radhika, good to see you after missing 2 weeks. I was away, but Macro Sutra did not stop. Very, very big announcement by the RBI day before yesterday, reported in the media yesterday. So, like we always do, go back a little bit. What was the need for the RBI to announce this kind of intervention?
Yeah. So these measures are in a series of a number of measures that the RBI has been announcing or RBI has been doing over the last few months. And the main trigger, as you rightly pointed out, has been that rupee has been consistently declining against the dollar. And that is obvious. The reason for that is that our current account deficit has risen because we are an oil importer country. We import around 85% of our oil requirements from abroad. So when oil prices and commodity prices are rising, so our current account deficit will rise. So there will be greater dollar outflows that will lead to rupee getting weaker. So that's one reason. The other reason is that because of the war and global uncertainty, foreign institutional investors have been exiting the Indian market. Primarily due to risk of sentiment, that because of uncertainty, the risk appetite has gone down for foreign investors, so they tend to move towards safe haven assets, which is dollar. The other reason for FPI outflows is that the dollar denominated bonds are fetching a higher returns, are fetching a higher yield. So when the US Federal Reserve has increased the increased the rates, and therefore the US bond yields have inched up, the differential between the Indian bond yield and US bond yield has narrowed. So therefore, even if there's a slight increase in the US bond yield and this differential gets narrowed, there is a tendency for FPIs to flow out of emerging economies, including India. So these two reasons have led to a decline in the external value of rupee. Now, initially what the RBI was doing was frequently intervening in the market. Okay, so that was the main instrument in its policy toolkit to prevent the slide of rupee.
So when you say intervening, selling dollars?
Selling dollars. So it's selling dollars and buying rupees. But the implication of this is that the forex reserves were declining. So, at the start of the war, just before the war, our forex reserves were around $620 billion.
Yeah, and now it went to 630 also at some point of time.
Yes. So they were quite high and they were quite comfortable. And now, within a span of 2 months, the forex reserves have declined by $40 to $50 billion. So there is a limit to how much the Reserve Bank can intervene, because we keep talking about having comfortable forex reserves, and then if forex reserves are consistently declining, there are questions on vulnerability. So intervention was one step. Then the other step the Reserve Bank, or we can say the government, took to rein in the current account deficit was importing duties on gold, because gold import was rising, and that was leading to
Dollar
deficit,
outflows.
dollar outflows and deficit rising, rupee again sliding. So the Reserve Bank, the government imposed, hiked the import duties on gold. That was the second step. And now they have moved to more sensible set of measures, which is on the capital account, of balance of payments. So the Reserve Bank has taken steps to incentivize more foreign investments.
So
And
can you explain these? I mean, I know it's a very, as we were saying, it is quite technical in nature, and I'm sure our viewers would like to know some of these, the key ones.
Yeah.
So maybe the 2-3 key steps the RBI has taken.
Yes. So primarily what the Reserve Bank has done is liberalize the capital controls, or what we say restrictions on foreign investments in Indian bonds. So that is the first big step that the Reserve Bank has announced. So if we look at our government bonds and corporate bonds, there are some restrictions on how much foreign investors can invest in Indian government bonds and Indian corporate bonds. So the restriction is 6% of the outstanding bonds. Okay, so however, the quantum of bonds that are there in the market, up to 6% of that outstanding bonds values can be invested by FIIs. Now, in 2020, again due to during the pandemic time, the Reserve Bank followed one instrument of liberalization, that for some bonds they said that this limit will not apply.
Okay.
So this limit of 6% will not apply, and foreign investors are free to invest as much as they like on some securities or on some government securities. So those were 5, 10 and 15 years maturity.
Tenor. As you call
10.
that.
So now what they have done a day before yesterday is that they have widened this list to include 7 and 4 also. So that is the one thing that they have done on foreign investment in local currency bonds. Similarly, they have done some liberalization on the corporate bond also, which is that they have now allowed foreign investments in commercial papers, which are like short-dated bonds. So that's one set of step. The other step is that they have liberalized the foreign currency borrowing also. So one instrument is that the FPI, though, when we say FIIs who are registered with SEBI, they come and invest in Indian bonds, which are denominated in rupees. This is just the opposite of that, where Indian companies access funds from overseas markets, which can be in dollar, which can be in yen, or any other foreign currency. Now, there is a framework for that also, which is called external commercial borrowings. And there are set of controls, there are set of restrictions that, which kind of company can borrow, how much they can borrow in any financial year, for what purposes they can borrow, what is the interest rate at which they can borrow. So some of these parameters have been liberalized in this announcement, that they have doubled the limit from USD 750 million to 1.5 billion dollars. So in fact, that is again one measure to attract dollars, because now you are incentivizing companies to borrow more from abroad. So that's the second step. And the third step is that they have done some measures to incentivize banks to attract greater non-resident deposits. So we have these FCNRB, which is foreign currency non-resident bank deposits, and then we have non-resident rupee deposits. So on these deposits, the interest rate ceiling has been dispensed away with. So that will enable banks to offer higher interest rates on investors who place their deposits. So this is the gist of some of the measures.
On the last one, Radhika, I have a question that why, I mean, of course, a lot of NRIs have bank accounts in India, NRE bank accounts as they call them, and they deposit money. And you increase the rate there so that they get some higher interest rates there. But much of that, if they want to take benefit of these rates, they have to spend it here, right? I mean, if you repatriate that, there's again going to be a loss due to the exchange rate, and especially now when the rupee is falling.
Yeah, to some extent. So, for example, for FCNRB, there is a facility for repatriation. For NRE also there is another called NRO. There it is not repatriable.
Okay.
So here it is repatriable, but again the problem is that it might not lead to a sudden surge of deposits, because then banks have to compete with other avenues which may also be offering higher interest rates. So, and the other point is that it's open for a very limited time. This window of dispensing away with the interest rate ceiling, it's only till October.
4 months.
Yeah.
So you're quite circumspect. You're not very excited about these steps, which is what I was. It's there in Radhika's column, Macro Sutra, printed, published on our website today. The link will be in the notes of the show. You talk about uncertainty. What is this uncertainty?
So, uncertainty, first element of uncertainty is that it is available only for a limited window. All these measures, they have been either they are available only till 31st October or 4th of November. So, and it's not clear whether the Reserve Bank will further enhance this limit or extend this dispensation for a few months more, because it's not that this uncertainty is going to end by October. And whenever foreign investors make these kind of decisions, they do take certain medium to long term horizon into account. So if they know that it's only for 2-3 months, and maybe this decision is reversed, and it is reversed by a much larger level. So then this entire thought process behind investing in Indian markets, it might prove counterproductive. So all these measures need to be followed by greater certainty that these will be there, or there should not be such limited time frame for these.
You mean it should have been for a longer duration?
For a longer duration, or it should have been there, because the problem is that I have cited one data which is on the utilization limit. Okay, so foreign investors have been allowed to invest up to 6% of the outstanding, as I mentioned, outstanding bond issuances. But if we look at the utilization, in fact, this limit is also not utilized. So only 28% of this limit is utilized. So this means that there is some problem somewhere.
So the appetite is not there.
Appetite is not there. So the existing limit is not exhausted. So that means that
what is the point of raising
What
it?
is the point of raising, unless it is accompanied by reviewing the reasons which might have led to this lack of appetite for government or
Do you want to
corporate
guess
bond?
the reasons?
So the reasons is this, that there is so much complication. The framework is quite complex. So if I start explaining, it's so complex. Like, there is this limit of 6%. In addition, there is a limit for short-term investment, that for a particular FPI cannot invest more than 30% foreign portfolio investors.
FPI. Sorry, I misheard it as FBI. Okay, sorry.
So if a particular foreign portfolio investor cannot invest more than 30% in short-term bonds, because the thought process is that short-term investments are volatile, so you don't want to allow more than 30% of each foreign investor's investment in short-term bonds. So now till October, this requirement is dispensed away with. Till October. So it might not create that incentive. So that is on the structure. And if we look at the other measures, we can talk about the foreign currency.
I was actually more keen on you to explain. You talk about systemic risk concerns if the borrowings are unhedged from currency fluctuation. Can you explain this hedging, unhedged situation, Radhika?
Yeah, sure. So in simple terms, here what is happening is that the company is borrowing in foreign currency. So the company is borrowing in foreign currency at this particular prevailing exchange rate. Now, if the exchange rate, say currently it is 79 rupees per dollar, at the time of repayment, if it becomes, say, 82 or 83 rupees per dollar, if the currency depreciates further, then the repayment burden of companies will rise. Okay, so what the company would have to pay at 79 rupees per dollar, now the company has to pay more if the exchange rate depreciates. So in a situation where the rupee is sliding, there if you allow more of foreign currency borrowing, it creates this kind of a risk that the company might not be able to pay. It may be that one company is not able to pay, but the systemic risk that I'm trying to explain here is that if a large swathe of such companies are face this kind of an exchange rate risk, and it starts affecting their repayment possibilities, then there could be a systemic risk problem, and therefore the policy prescription which is normally advocated is to allow more of local currency investments. Like the first point, where FPIs are allowed to FPIs, foreign portfolio investors, are allowed to invest in rupee denominated government bonds or rupee denominated corporate bonds. Here the exchange rate risk is not borne by the issuer. The exchange rate risk is borne by the investor. Whereas here in external commercial borrowing, the exchange rate risk is borne by the company. Now the other problem is that currently interest rates are rising.
Yep.
Okay. Now, just before this spell, ECBs or external commercial borrowing had become very popular because if we look in the advanced economies, because of the ultra low interest rates, companies did a lot of foreign currency borrowing because India's interest rate was still higher, and in other countries, advanced economies, interest rates were much lower because the policy rates were almost touching zero. So they did a lot of foreign currency borrowing. But now, because the interest rates in the US has been rising, how much company can borrow and what is their appetite, it will come down, because firstly interest rate is rising, and secondly exchange rate is depreciating. So at this doesn't sound to be too timely to allow more foreign currency borrowings.
So you've talked about fundamental reforms, and fundamental reforms in these areas are, I don't know if they can be short term or medium term or long term. Do you want to quickly touch upon that before we take some questions from our viewers?
So fundamental reforms is, there are three elements to this. Firstly, and there have been a lot of discussion about this over the last couple of years. There are a lot of expert committees instituted by the Ministry of Finance who have talked about the complex framework of India's capital control, and if that can be liberalized, it will help in ease of doing business. While a lot of this capital control framework has been liberalized, but still there is scope for looking at the fundamental reforms, which is firstly according more certainty, secondly reducing the over prescriptive attitude, like this much you can invest in short term bonds, this much you can invest in long term bonds, these are the securities in which fully accessible route is allowed. So the point is to make the framework more simpler, like we have in some of the advanced economies, because here when you have very complex framework, then the RBI has, or the regulator has a lot of levers to just tweak some instruments, and that may not result in material improvement unless and until there is a holistic simplification of the framework. So simplification is important. At lot of levels there are caps, there are limitations. There are not only caps, there are other requirements also. So there is a need to do a thorough review of the framework and to simplify it as much as possible.
Are you optimistic that this can happen in the
I am
near
optimistic
future?
because some of these reforms that have been implemented, even those, when we started working on it around 2014-15, even these were considered very far-fetched. But, because earlier, now we have this percentage-based limits. Earlier, we used to have something called quantitative limits. We are just putting a number. Now, even if the market size is increasing, you are just saying X billion dollars and not more than that. So we started advocating at least make it percentage based, and now we have percentage based. So yes, things are moving, but at this point in time, there is a need to a further review of the framework and make it more simpler.
Okay. Let's take some questions, Radhika. The first one is from Malkhed Sushil. Hello, Malkhed. Thank you for watching us. To what extent under-invoicing of exports and over-invoicing of imports is responsible for trade deficit and thereby depreciation of the rupee? I'll rephrase this a little bit. should the Ministry of Commerce play a role in stabilizing the rupee?
So the government is, playing a role. The Reserve Bank is playing a role. Now, at this point in time, the trade deficit rising is primarily due to the war-related disruption. And again, when we talk about over-invoicing and under-invoicing, we have to see that if there are some, unnecessary restrictions in place, these need to be eased. So once those are eased, these problems of over-invoicing and under-invoicing can be taken care of. But at the moment, it is more due to, rupee sliding, due to your current account deficit, which is fundamentally due to our imports rising much more than exports.
Shantanu Raghav. Hi Shantanu. Does the government have any plans to set up a bond market to allow for companies and institutions to avail more capital?
So, government setting up bond market is what is more important is that the existing bond market which is there needs to be made more liquid. Right now, the problem with the India's debt market is that it is not liquid. So if we look at the equity market, it is much more liquid in terms of market capitalization and trading volumes and so on. But if you look at our debt market, there are only very limited amount of securities which are traded. The 10-year bond and very limited amount of securities are traded. And if we come to corporate bond, it is even more illiquid because only, there's some AAA rated bonds which are highly liquid. But if we look at AA rated and single A rated bonds, there is hardly any market for that. So the government has taken some steps. When Arun Jaitley was the finance minister, he announced certain steps that, companies, the investors should invest some part in AA rated or single A rated bond, incentivize them to invest in more illiquid bond. But again, what is important is to see why the bond market is illiquid. And again, the thing is that because Reserve Bank is regulating the bond market, SEBI is regulating the equity market, there is a lot of regulatory arbitrage. And those things need to be addressed. And that's a bigger agenda.
Okay. Arnab Sinha says, historically, the INR has always been depreciating against the dollar. So is it a good strategy for the small investor to keep savings and investments in dollars to remove these risks? But is that even possible? How can small investors keep your savings in dollars?
Yeah, that's not
which means you do that LRS and where do you put it? Which foreign institution do you put it?
So you have already answered this.
It's not a feasible proposition or option, Arnab. Last question for the day from Dr. Akshay. Hello, Dr. Akshay. No, there's one more question. Sorry, that's not the last question. Can we say capital flight is also the main reason for the falling rupee? And if yes, then what measures can the government take to tackle capital flight?
Yes, so capital flight has been happening, and we have seen for the last 6 months the pace of capital flight has intensified for the reasons we spoke about. There are some pull factors and there are some push factors. The push factor is that the US bond yields are rising, so it's pushing the foreign flows out of India and moving towards more advanced economy. What we can do from our side is to work on the pull factor, which like RBI has introduced certain measures, and if these are supplemented by more fundamental reform, and given this kind of an the perception that these reforms will remain and there's some kind of certainty, then I think that's a pull factor. And the other thing is that focus has to be on macro stability. If the economy has manageable fiscal deficit and current account deficit, foreign inflows will flow when the situation in the US stabilizes.
The last question definitely is from Saloni Sehra. Why are FPIs not confident about India's debt instruments?
So FPIs are not confident about India's debt instruments, firstly because the market is not liquid. So, the very important resource to look into is have a look at the Asia Bond Monitor. Okay, so that gives you a comparison of Asian bond markets across various countries, and there you will see that the kind of exposure that local currency debt markets have in other countries we do not have in India. One, because our debt to GDP ratio is quite high, our fiscal deficit is quite high. So whenever foreign investors make this decision, it's not an absolute decision. It's a relative decision based on, looking at various fundamentals, looking at the country's debt, looking at the country's policies, whether those policies are certain, whether there is certainty, what is the political environment, whether there's rule of law. There's a lot of considerations. So what needs to be done is that whatever controls we have, there should be a rationale for those. Those should be simplified. These distinction between short-term debt, medium, long-term debt, these need to be made more simplified and more rationalized. And on the market side, steps should be taken to make the market more liquid. Right now, there are only very limited participants in the debt market. So those need to be made more liquid so that FPIs can trade and there is greater volume and liquidity. Right now, it's quite limited. That's why we see more investments in the equity market rather than the debt market.
In the debt market. Thank you so much, Radhika. I must confess that, this is such a very technical issue, and I was telling Radhika at the beginning of the show also that, we need a lot of explanation. I have learned so much from this 30-minute masterclass, and I'm sure many of you viewers would also agree with me. Thank you for watching this episode of Macro Sutra. We will be back next week with another episode. Until then, take care, stay safe, and have a very good weekend.